I think that everybody's got the most important lesson is think for yourself and think really hard. If you lived your entire life in the United States and the last 30 years, you had no monetary network and you had the money supply expanding at 6%, then every model that you had was formed with those two assumptions. If I introduce a new thing, a monetary network, let's call that Godzilla, right? Or a monetary fire, that's one new thing. If I then expand the money supply by 24% instead of 7%, that's a second new thing. These are two new ideas.
In a world where yesterday's rules can't explain today's outcomes, Michael Saylor frames Bitcoin not as mania, but as a response to new first principles. When the base layer changes, the models built on it crumble, and investors must rebuild their thinking from scratch. That reconstruction starts by separating reflex from analysis, narrative from mechanism. If money itself is shifting, then price action is a signal, not a siren. With that lens, the bubble label becomes a shortcut that misses the deeper migration underway.
When you say it's a bubble, it's just another excuse to not think, I think. It's just a knee-jerk reaction. For example, if you go and you chart the US dollar against the peso in Argentina, it looks the same as Bitcoin. Right. So if your definition is up to the right as a bubble, well, then the US dollar is a bubble in Argentina. If you chart the US dollar in Zimbabwe and Venezuela, it also looks like a bubble. So if you're going to take that position, does that mean you're going to dump the US dollar? Would you trade back into the Venezuelan bolívar or the Argentine peso or the Zimbabwe currency for the same reason? And the answer is no.
Saylor's challenge is simple. Context matters. What looks like irrational exuberance in one currency frame can be straightforward survival in another. Capital flees failing stores of value, and the price chart merely records the escape route. If you wouldn't run back into a collapsing currency elsewhere, why cling to assumptions that deny the same dynamics at home? The real question is not whether lines go up and to the right, but why people are moving at all.
If you can put yourself in the position of another country or another frame of reference, expand your worldview, then you see there are two reasons something goes up. One is it's being artificially squeezed up in a bubble. Another is there's just a rational flow of capital from a weak asset to a strong asset. And you got to ask yourself the question, are you invested in the weak asset and is it going to the strong asset or not? I think what you see here with Bitcoin is what you see is the flow of capital from weak assets to strong assets.
Here he pivots from labels to mechanics. Investors are choosing between melting ice cubes and harder assets, and they're doing it across borders and regimes. Once you see the migration, the debate shifts from, is it a bubble, to which side of the bridge am I standing on? That's not hype, it's rotation. And rotations are driven by incentives, not headlines.
People keep saying Bitcoin is volatile, but people use the word volatility without thinking about it in the same way they use CPI without thinking about it. CPI is not inflation. You've just been brainwashed to think it's inflation. CPI is one of 1,000 measures of inflation. And, you could also calculate monetary inflation. It's a totally different number. Volatility is not risk. Volatility is a measure of risk. But it turns out that if you calculate volatility of LeBron James on a basketball court, he's the most volatile player. He's also the best player in the world.
This reframing punctures a favorite objection. If volatility simply records the pace of change, then leadership assets will often look noisy as they outcompete. Markets crown winners not for their calm, but for their capacity to absorb demand and deliver utility. Calling that risk confuses motion with fragility. The better lens is to ask what that motion is accomplishing.
If you look at the volatility of Tom Brady, he's the most volatile player on the court or on the field. He's also the best player on the field and the most important player on the field. The winning team is always the most volatile. In fact, the winning everything in every field, art, music, war, Julius Caesar was volatile. Alexander the Great was volatile. Generally, the thing that's actually acting, right? If you're in a boxing ring, the fighter that's actually throwing the most punches is probably the most volatile and is also the winner.
Momentum with purpose is different from chaos. Saylor argues that Bitcoin's punches are adoption waves, protocol upgrades, and capital inflows, all compounding over time. That activity reads as swings to those watching the scoreboard, but as progress to those studying the game plan. The scoreboard will catch up. The strategy already has.
So the only reason Bitcoin is volatile for the past 12 months, by the way, is it keeps going up. If you look at it and you go, oh, well, it's volatile. Well, it's volatile because volatility measures the rate at which something doubles too. And if it doubles and doubles, and if I give you the asset and I said, well, Michael, this is going to double every year, every 6 months for the rest of eternity, it will be, by definition, the most volatile, defined by volatility metrics. Are you going to run from it or toward it?
Here, the metric meets the motive. If compounding is the engine, then volatility becomes the receipt of growth. Investors can recoil from the math or recognize it as the characteristic signature of exponential networks. The question is not whether the plotline jiggles, but whether the curve keeps compounding.
Bitcoin has been growing at 200% a year, every year for the last decade, because of technical utility against monetary inflation of 7%. Okay, Bitcoin is growing 500% in the last 12 months. Why did it accelerate? Well, if I have a monetary fire, what feeds the monetary fire? Money. Right? If I print money, if I triple the rate at which I'm printing money, don't you think that something that has been growing before will grow even faster?
Now the macro catalyst slots into place. Policy accelerants don't create the network, they amplify it. When incentives align with utility, adoption curves steepen and infrastructure follows the capital. That is not a speculative fever. It's a feedback loop between technology and money.
Those two things put money in the system, which encourages technical utility. Hence, PayPal turns on. Square just added a new feature. You can now send Bitcoin to a Square's cash tag instantaneously, no fee. So if I wanted to send you $50 in Bitcoin, I can do it in a second, no fee. That's technical utility.
Utility is the tell. When moving value gets faster, cheaper, and more programmable, the asset stops being a ticker and starts becoming a tool. Tools that solve real problems don't vanish when sentiment shifts. They entrench. Each new feature is not decoration, but distribution. Across currency frames, through the fog around volatility, and into the engine room of adoption, Saylor's case is that Bitcoin's rise maps to capital flight from weaker stores of value and the compounding utility of a monetary network. What some call a bubble looks, in his telling, like a migration to strength, a technology whose usefulness increases as more people use it, and a macro backdrop that accelerates rather than invents demand. The narrative isn't that price alone proves anything, but that price, policy, and protocol are now entangled.
So one can think that there's no reason why Bitcoin shouldn't expand to flip gold and then to replace negative yielding sovereign debt and then to replace money markets and savings accounts and cash accounts. That's a pretty clear line of sight to $100 trillion or more, 100 times bigger than it is right now. And when it gets there, because it's a deflationary asset and you can't make any more of it, it should still accrete in value at the rate that the cyber economy grows in productivity, right? That's basic Austrian economics. If the overall cyber economy and all the companies that are relying upon digital gold as their base layer, if those companies are growing 5%, then the Bitcoin will grow at 5% even after it's fully adopted by everybody on Earth, right? It's always going to be a better deal than the underlying savings account that yields nothing and pays you in a currency which is debasing at 7% a year.
Do you agree that what many call a bubble is really a long migration from weak assets to a stronger monetary network? Or do you see a different ending to this story?